BRICS, gold, sanctions, de-dollarization, dollar collapse. The headlines sound final, but they miss the dollar system that matters most. Move the dollar by 1% and the world recalculates. Fuel, debt, mortgages, pensions. One currency reprices obligations far beyond American borders. There is the dollar the Federal Reserve issues. Then there is the offshore dollar created by banks outside the United States. The second system is distributed, private, and enormous. London banks lend dollars to Zurich. Zurich funds Dubai. Dubai settles with Singapore. These balances move without touching a stack of American cash. They are dollars because the contracts say they are. The measured core alone is roughly $13.7 trillion. That is not the full system. It is the part regulators can count with reasonable confidence. Add loans, deposits, bonds, foreign exchange swaps, derivatives, interbank claims. The boundaries overlap. The reporting gaps widen. The true total becomes unknown. The Fed controls base money, domestic reserves, and access to its own balance sheet. It does not approve every offshore dollar loan. It does not supervise every foreign balance sheet. A bank outside America approves a $100 million loan. On its balance sheet, the loan becomes an asset. At the same moment, the client deposit becomes a liability. New dollar credit now exists. This is not counterfeiting. It is bank credit creation. The asset and liability rise together. No printing press. No palette of notes. Just an enforceable promise denominated in dollars. The old textbook reserve ratio does not explain this market. The binding limits are capital, liquidity, collateral, regulation, and confidence between institutions. The Fed does not control every node, but its rates pulse through the network. Some banks reprice instantly, others react late. Weak institutions can lose access entirely. The name began with dollars held outside the United States, especially in post-war Europe. Eurodollar never meant the euro currency. It meant offshore dollar deposits. London became the engine. Banks could transact in dollars beyond several American restrictions, connect global borrowers, and build a wholesale market around offshore balance sheets. A European bank funds an Asian company. The company pays a commodity exporter. The exporter deposits the dollars with another bank. That bank lends them again. The loop compounds. Each link creates another claim. A loan supports a deposit. The deposit supports collateral. The collateral supports another loan. Liquidity appears deep while every participant keeps rolling the chain. Why dollars? Because oil, shipping, trade invoices, corporate debt, and derivatives already use the same unit. A shared denomination removes conversion friction from global contracts. More dollar users create more dollar liquidity. More liquidity lowers transaction costs. Lower costs attract more borrowers, lenders, and hedgers. The network strengthens itself. The assets may mature in years. The funding may expire overnight. A bank can look solvent on paper and still fail tomorrow morning if lenders refuse to renew. In calm markets, dollar funding feels unlimited. In panic, bids disappear. Haircuts rise. Credit lines close. The same network that created liquidity begins destroying it. Long-term dollar assets sit on top of short-term dollar promises. The mismatch is profitable until refinancing stops. Then time itself becomes the risk. During a global dollar shortage, foreign central banks need dollars fast. Federal Reserve swap lines become emergency pipes, sending liquidity to selected monetary authorities. In crisis, those facilities can expand by hundreds of billions. The rescue reveals the contradiction. Offshore creation is private, but catastrophic dollar shortages demand public backstops. Banks collect the spread in normal times. Central banks stabilize the network in exceptional times. Profit stays private. Systemic liquidity risk migrates toward public institutions. But swap line access is not universal. Core allies receive direct pipes. Other countries rely on reserves, expensive market funding, or emergency programs. In a dollar panic, hierarchy becomes visible. The Federal Reserve supplies ultimate liquidity. Private banks create much of the offshore credit. One side controls the emergency valve, the other side builds the pressure. No single dashboard captures every offshore loan, swap, derivative, and contingent claim. The system is measurable in pieces, but not perfectly observable as one total. The same architecture gives the dollar extraordinary global reach. It also spreads funding shocks across borders. Scale is the advantage. Scale is also the vulnerability. Companies owe dollars on fixed dates. Banks face collateral calls in dollars. Investors hedge in dollars. When everyone needs the same currency at once, demand becomes mechanical. Dollar demand rises. Funding costs jump. Assets are sold for cash. Prices fall. Collateral weakens. Lenders demand more dollars. The loop accelerates itself. Replacing the dollar requires more than political intent. A rival needs deep credit markets, trusted collateral, open capital flows, legal certainty, and liquidity in every major time zone. Declarations happen instantly. Financial infrastructure changes over decades. Contracts mature slowly. Payment habits persist. Collateral networks resist migration. The incumbent keeps compounding its advantage. The dollar is not merely America's currency. It is the operating language of global credit. Much of it is created beyond America, yet the world still depends on America when the system breaks. Global money, global risk.